It's happening and happening sooner than we thought. Right out of the gate, 2022 interest rates taking a spike. Here we go. So how will this affect mortgage payments? When will prices go down? And will the housing market even crash? Let's get into it. Hello everyone, it's Wayne Turner. Thank you so much for watching this video. I'm going to come at you pretty quick because it's important information, really good intel, but I know your time is really valuable, so I tend to talk a little fast, but I'm hoping I can get the point across without boring you and dragging a lot of this stuff on. Now, before we get started, if you don't mind, just give us a subscribe. If you like this channel, please subscribe to it. Give us a thumbs up, a like, and you can press the little thing and leave a comment and you get all of that. Now, as I had mentioned in a previous video, Feds cut stimulus. I'll put a link below for you to catch up on that if you wish. Just as the Feds cut stimulus, they also spoke of interest rates and how the interest rates were going to increase. Now, it did exactly what they anticipated it doing. Just by mere speaking and talking of interest rates, bond owners, bond investors began to sell off bonds. Now, they did this as predicted, which causes the bonds to price to go down and the interest rates to go up. Now, why would they do that? Why would you sell off your bonds? Well, it's real simple, money, to save money. So when the federal government talks about we're going to lower the rates, then people with bonds are like, well, we're going to sell off our bonds. So by selling off our bonds, it increases the rates. Now, all of this is coming way sooner than we anticipated. All of it, you know, with the rates and the jump. Right now, we went from a 3% to a 3.5% mortgage rate. It seems like pretty much overnight over the period of really around 6 to 8 weeks. Now, this is what we need to happen. If you don't, it will never stop. It's kind of tongue-in-cheek catch 2020. People are like, man, everything's going up, and they're raising their rates. And it's like, we can't have our cake and eat it too. Unfortunately, we've got to slow the economy down because it's just kind of going nuts right now as far as pricing of everything. Here's what I tell people. So everything's going up. So the prices of everything are going up. So if you own a business, you sell goods, services, commodities, whatever it may be, you're like, oh, I can increase. Well, you can increase, which increases sales, right? Well, that increases sales and makes you more money, but everything that you purchase with that money goes up, except for real estate. Real estate does go up, but after you purchase a property, your mortgage payment doesn't move. Your principal and interest is there. It's a fixed rate. That rate will never stay. That rate will never move. It stays the same for 30 years. So how will a rate hike affect interest payments? How will a rate hike affect mortgage payments? I'll give you a prime example. On a $300,000 house. Now go with me. If you're watching this video, you may say, well, look, $300,000, that's not a house in my market. There's no way. I live in Portland, Oregon. The average sales price is $7,000. I get it, but for the video, we're just going to use $300,000. Now, principal and interest on a $300,000 home at 3.5% interest is $1,347 a month. That same note payment, if you will. Now, as I mentioned before, that's a fixed rate. You get a mortgage, that payment will not change. Now, your payment can change if your property taxes go up, your insurance goes up on the property, but as far as your principal and interest, it's staying the same. It is fixed. So the difference between 3.5 and 3 on a $300,000 house, one's $1,347 at 3.5, the other's $1,265 at 3. It's like an $87, $80, $82, $83 difference in the price, which is still around $7,000 over the course of 7 years. Now, that may not seem like a lot of money in retrospect, but there's a couple of things that happen here. Go with me. Now, a couple of things that can happen, and as I mentioned, $82, $84 a month, $7,000 over the period of 7 years may not seem like a whole lot of money. It's minuscule for some folks, right? I get that. But for some folks, it's a lot of money, and for some folks, if you're buying that first-time home buyer home, it gets you priced out of that market. You may be right on the cuff of, you know, you're buying the house that you really like, and now you can't buy that house that you really like, or you're buying the house that you really like, and now you just simply have to pay more money for that house. So the difference in that same $300,000 home, 3.5% interest, if you take it to 4% from literally 3%, so now you 3%, and we may see in 12 months from now a 4% rate, the difference in that is about $14,000.
Oh my God!
Now, keep in mind, that's over a period of 7 years. That's $14,000. But, you know, it's still money. It adds up. I get it. Now, will this rate increase? Will interest rates increase affect home prices? Will home prices go down? That's the big question. And the quick answer is yes, they will. But it won't happen suddenly. As interest rates go up, we see people purchasing property. Why is that? Because there's a thing called FOMO. It's fear of missing out. So now you've been on the fence, you've thought about buying, you've contemplated it, And now all of a sudden, you're like, well, wait a minute, the rates are going up. They're talking about them going up even more, and they just went up. And so the phone is starting to ring. I can tell you just today, shooting this video as of today, we've had more buyer calls today than we've had in the last 2 or 3 days combined, just because as we roll into spring, rates go up. It's kind of the inevitable. You're going to get people to jump off the fence and purchase houses instead of just waiting because they don't want to be priced out of the market, and they certainly don't want to pay more for a property, the same property. Now, I witnessed this firsthand back in the 90s and the 2000s. They would adjust the rates, literally. They would go down and up and down and up and down and up. When they would take the rates down, people would get off the fence and they would purchase property because the rates went down, and the media would flash it everywhere, and rates are lower, so buy a house, right? And then it would level off a little bit after about 3 to 4 months, and then they would tickle the rates up again. So literally, it was like a dolphin in the water, just down and up and down and up and down and up. And it kept the housing market running for many, many years in that same cycle. The rates were still really low, and it was just kind of a drop, people jump, raise up, people jump, drop, people jump, raise up, people jump. But I think it's going to be a little bit different in this time and era as we roll into 2022 and into 2023. Now, the rates will slow, but we will see it over the period of probably 16 to 24 months. We'll see a gradual shift in the market. Now, when I say shift in the market, I mean it's really more of a balancing of the market. It's not going to be one of those things where, oh my gosh, nobody's buying houses, I must lower the price. But I can tell you that it takes a while for actual homeowners. 10, 12 months ago, if I told the average person what the market is, and I'm going to reach over here, I'm going to look at these. I do these reports. And if you want to see these, you can go to Turner Market Reports, just a little quick plug on my site. But I do these for the New Orleans metro housing market, where I sell and broker real estate here. And we do these reports, and I've been telling people literally for like 14, 16 months, we have no inventory. Like, nobody's putting properties on the market, and it keeps getting lower and lower and lower and lower. And the absorption rate, if not another single home was listed in the entire metro New Orleans area, for example, it would take about 6 to 8 weeks, and there would be no homes available to purchase. Is that your phone ringing? Do you need to answer that? Go ahead, you can get that. So we see a balancing of the market. And by balance of the market, I mean that it took homeowners a while to realize that they could sell their property for more than they ever thought possible. And just as that has been a realistic thing and a gradual thing, we're going to see homeowners begin to put their houses on the market. We already see it. They put their houses on the market, and then you see price reductions and price reductions and price reductions. A couple of things for that. One, you can ask for the moon and stars, but in the average American household neighborhoods, we're seeing a couple of things that keep prices from going crazy, and that's appraisals. When a property sells, it has to be appraised. And if the appraiser sees that it's justified, then they'll appraise it for the contract price. If they think it's inflated and they can't find comparable properties to justify that price, it won't appraise, and it's not going to increase in price. So that's what we see. We see the appraiser's kind of letting the leash out, if you will, to give people a little bit more grace and a little bit more leeway. But we're not in one of those markets, and I have friends all around the country where the average sales price may be $600,000, $800,000, $1 million, and they may sell a $1.6 million home, have multiple offers, and sell for $300,000 more and for cash. I mean, I hear crazy stories, but it's so true. Now, will the housing market crash? In my opinion, no, I don't think it's going to crash. I don't think we're going to see a crash necessarily in any one housing market. Now, I say that, I don't know what the future really holds. Nobody really knows. All we have is data, and that's the closest thing we have to foreseeing the unforeseeable future and looking into a crystal ball. But the reality is that no one truly really knows how the market's going to play out, what's going to play out, what's going to play out in real estate. But I do think that there will be a correcting in a lot of markets. And here's what I mean by that. There's some housing markets that have seen 24, 26% appreciation. And they may see 16, 17% appreciation in 2022. Now, keep in mind that appreciation compounds. So if you had a $600,000 house that appreciated 20%, which is 120 grand, and then now it's worth 720 as opposed to 600, and now it appreciates another 16, 17%. You can see how people bought a house 2 or 3 years ago for $600,000 can sell it and make $8. It's pretty unheard of, but that's the market that we're in. Now, how will this affect everyone else around the country? Well, go with me for a second. News, as we hear it and as we know it, unfortunately, anything that's negative tends to draw our attention. Now, some people say that, well, negativity sells. And it may not be so much as the negativity sells. I just think that we as consumers, when we hear things, we can't help but kind of open our ears and go, wait a minute, what's happening over there in California or Seattle? Whatever the city may be, I'm just using these as examples. But what happens is when we as consumers, if we're living in the average middle America, you hear these things where these properties have had double digits, 24, 26% increase, and then 16, and then 18, and then all of a sudden now it's like, oh, well, prices are dropping. Well, they're dropping, but geez alive, man, they went up so high that now they are dropping, but all we hear as consumers is prices are dropping, home values decline. Well, they do decline, but hell, they went up 40% over a period of 2 years, and it's not all that bad of a thing if they level off or if they take a pitch. And it's not necessarily what I mean bad. It's not bad for the overall economy. Sure, it may be pockets, and that's what I tell people. Literally, some neighborhoods sell faster than others. Some areas, cities specific, sell faster than others. There's no rhyme or reason. It just happens. It just tends to fall that way. And look, it's any information. It's information that causes concernment, I guess. And it doesn't really just matter about housing or cars or it's everything that we purchase as consumers. When we hear things that we may question a little bit and have a concern, it's hard not to go, well, whoa, wait a minute, maybe I should pull back, think a little bit before spending that money on that big ticket item. And at the end of the day, cash is king, right? So when will we see prices really go down? I mean, my prediction, I don't think we'll see it in 2022. I don't think we'll see a drop in home prices this year. We may not even see it in 2023. We may begin to see it in 2023, but not in 2022. Now, I base that opinion on just knowing how many people are working remote jobs. So think about this. Before the pandemic 2 years ago, 1 in 67 people worked from home or worked from a remote location or could work from a remote location. Now, 1 in 7 jobs that are being held and worked by American citizens are remote. 1 in 7 are remote. So think about that. It used to be 1 in 67, now it's 1 in 7. So more people are staying in their homes longer than ever before. They're just understanding that, hey, I'd rather trade not moving to this this big house to work a job that I really don't care for, don't like as much. I'd rather stay here and work from home and enjoy my home a little bit more. And let me know, do you agree? Comment below, please, and let me know what you think. So with the interest rates going up, the big questions are, how is this going to affect my home payment? Will the prices go down? And will we see a crash in the market? Your payments are going to go up if interest rates go up, but you also have to look at property prices will become maybe perhaps a little bit more realistic as sellers realize that what they're asking for the property isn't exactly what they can get for the sale of their property. And then will it crash? I personally don't think so. I've seen the ups and downs in the business now, 26 years, but I don't think we're going to have a crash. But you let me know. Tell me what you think. Until next time, we'll see you soon.